The Monetary Policy Committee at its meeting 10 to 11 decided to reduce the monetary policy rate by 25 basis points to 14.25%. The committee took into account that inflation has declined further in the third quarter, and the projections indicate a faster deceleration towards the lower bound of the 6 to 8% target band over the forecast horizon. The committee was also mindful that inflation still remains above the target band, and market expectations of inflation, although lower this time, remain elevated. So now let's see what exactly we are talking about, inflation decelerating. So what we observed is that the downward trajectory in inflation accelerated in the third quarter, with inflation declining to 12.3% in September from 14.1% in June. Go for more information here on table 1. This is the usual table that we share. It's divided in two parts, as you may recall. The first part, the upper part, is average, and the lower part, we are talking of the end period figures. So if you look at the upper part, overall inflation declined from 15.3% in the second quarter to 12.6% in the third quarter. Food inflation, which is a major component of this overall inflation, also declined from 17.7% to 14.9%. Equally, non-food inflation declined from 11.8% to 9.3%. These are average figures, but annual numbers. Then when we look at the end period numbers, the overall inflation also declined from 14.1% at the end of the second quarter, which was June, to 12.3% in September. And food inflation declined from 16.7% to 14.6%. Non-food got even into single digits from 10.3% to 9%. Now, in terms of the contributions to this inflation that we are reporting on, there are two aspects, as I indicated. You have the food side and the non-food. So the left panel on this slide is showing inflation, the contribution of food inflation. I think what you see here, which is what I'll come back to, is that there's a bit of stickiness. We had expected that the food inflation would fall down much faster, but that wasn't to be so. Now, one of the sticky areas we note, as you see from the chart there, is the vegetables. That dark, you have blue, and in between there. It seems like our farming habits have changed, because usually during this period, people grow a lot of vegetables and the prices tend to drop, but this is not happening. And this is not just this particular quarter. We have seen that even last year, I think it was the same case. So I think we need to get down to growing more vegetables that can stabilize the price of food. Then on the right panel, we have the contribution to non-food. There, I think one to stress is the transportation. If you look the brown, the yellowish at the top, you see there it was pronounced in the earlier quarters, but it was gradually coming down. If you see in the very last bar there, you see that that yellow, is it orange, it's much smaller, which is what is contributing importantly to this decline that we have seen in non-food inflation. Let me go back to where I left. Now, if we go beyond the quarter, which is October, we see that inflation fell further down to 11.9%. So it's inching towards the target band, but still above the target band. Now, what were the key drivers? We cite a few here, mainly the continued appreciation of the kwacha against major currencies and the impact of the recent bumper maize harvest, which has contributed to the lower prices of maize grain and maize meal. So this is still going on. We're yet to see whether it has really played out altogether, but it's a matter we will share in the next meeting. In terms of outlook, we have observed that when we did the revisions to the forecast, that for the year as a whole, we see that inflation has actually gone up slightly to 13.8% from 13.3% when we did the projection in August. This, as I indicated earlier, was on account of slower than anticipated decline in food prices. I think I did share with you the charts there. Okay. The chart 3, it brings this out very clearly. But before I come to that, let me just go back to where I left so that I complete this and then show you in graphical terms. So what we observe further is that from the second half of 2026 to the end of the forecast horizon, which is up to the third quarter of 2027, inflation is forecast to decelerate faster than earlier projected in August. It is forecast to average 7.6% in 2026 compared to 7.7% we projected in August. In 2027, inflation is projected to move closer to the lower bound of the 6 to 8% target band, averaging 6.6% over the first 3 quarters of the year. That's the forecast horizon. We go up to the third quarter. So throughout that, inflation is coming down. The main factors are lagged effects of the appreciation of the kwacha against the US dollar, lower fuel prices, and downward adjustment in electricity tariffs to residential customers. The risks to the inflation outlook are still assessed to be supportive of lower inflation. And these include the favorable weather forecast for the current farming season. We hope that that continues to be the case. Improved external sector conditions reflected in higher copper export earnings and subdued crude oil prices, and the observed easing of geopolitical tensions. So graphically, this is what I was trying to say here. If you look on the chart on the left side of the panel, the red dotted line was our projection in August. The one which is now blue, the dotted line, is what our projection is showing in November 2025. What you see is that although at the beginning the forecast is a bit sluggish this time than was the case, but the last time we are seeing that inflation was coming down but still moving towards the top part of the target band. But this time around, as you see, it's moving towards the lower bound, which is the 6% of our target band. So the idea is to have inflation within that band. So in terms of figures, which I read out, they are contained in the small table on the right-hand side of the panel, where I said that if you look at the August of projection for 2025, we had projected that inflation would end at 13.3%. But this time, because of that sluggishness in the movement of prices for food, it is projected to be ending at 13.8%. For 2026, we had projected that it would be averaging 7.7%. We are now projecting that it will average 7.6%. And for the 3 quarters in 2027, previously we had projected that it would be 7.7%, but now we are showing a much lower figure of 6.6%. Moving on to the foreign exchange market, which, as you have noted, is one of the key drivers in the movement in the exchange rate. What we observe is that the exchange rate continued to appreciate in the 3rd quarter of 2025, although at a reduced rate. So it's still appreciating, but it did so at a reduced rate. The kwacha gained by 3.1% against the US dollar, compared to 14.4% in the 2nd quarter. This is the chart on the right-hand side here. You note that the solid line that measures the movement between the kwacha and the US dollar. Then the brown numbers, those are average. They are monthly percentage changes, which is the brown. As you see, there's a line there which shows that if you are above, that is depreciation. If you are below, it shows appreciation of the currency. What we observe too is that during this period, the elevated demand by the energy sector and the conversion of maturing government securities, including coupon payments by non-resident investors, accounted for the slowdown in the rate of appreciation. In other words, we are seeing that those investors who had invested in government securities, they were converting their coupon payments. These are the payments that are made every 6 months to those who hold government bonds. So when they do that, that means they cash in and get dollars for that to remit. And that's what contributes to that. Then we are saying that also the kwacha appreciated further by 3.9% in October. That's just in the month of October, mainly supported by increased supply of foreign exchange by the mining sector. Remember what I said earlier about that the contributors are the good copper prices and the production of copper. A weaker US dollar also contributed to the strengthening of the kwacha. So let me show you graphically what we are talking about here. If you look on the chart 5, which is on the left-hand side here, the brown line is showing the US dollar index. So we trace this as far back as December 2020. So you can see in that period it was rising when just after COVID, the dollar was strong because if you recall that time we are talking of also the tightening of monetary conditions in the US. But since then, it reached a peak and it has been coming down to the current level where it is so low. Then the blue line is showing the one for emerging markets. This is a basket of emerging country currencies, where you can see that whereas their measurement is going up, whereas the dollar is going down, which means that these currencies were gaining against the US dollar. So we selected some to show that clearly. This is what is showing on chart 6 on the right-hand side. So you will see there that the kwacha is the 3.1% that I mentioned of appreciation. There are a number of others who were in that range: the Nigerian naira, the Brazilian real was also at 3.1%. Topping the list was the Tanzanian shilling. Then you see others. The easy way to look at this, there's a line there, zero line, vertical zero line. On the right, it means appreciation. On the left, it shows depreciation of the currencies mentioned there. Further, in the foreign exchange market, I did mention that the mining sector was the largest contributor to the foreign exchange supply during this period, and indeed, a net of $440.5 million was sold directly to the market. That means the mining sector was able to offload $440.5 million to the market directly. This is a much higher figure than was the case in the previous quarter, where they offloaded $418 million. So this is what is showing here on the right-hand side in the chart. But that was not all. They also remitted directly to the Bank of Zambia $196.3 million, although this was lower than what was remitted in the previous quarter. In the previous quarter, they remitted $262.1 million. So the supply to the market increased, but in terms of the tax payments, reduced during this quarter. Further, in the foreign exchange market, that while supply of foreign exchange by the mining companies improved further, the significant drop in net inflows from non-resident investors led to a decline in overall supply. Here you see this chart on the right-hand side. If you look at the top part, look at the zero line there, you see there is deep green color there. If you look, that was 2023 Q2, that's when it was biggest. Since then, it disappears, it comes back. The last quarter, it was quite sizable, you see that. But come this previous quarter, we see that it was shrunk, which means that they were not significant players in the market by way of supply. Now, to moderate the volatility in the exchange rate and support importation of critical commodities, the bank provided market support of $120 million to the market. As a result, excess demand reduced substantially to $24 million from $156 million in the second quarter. So this is the foreign exchange story and what informs the movement in the exchange rate. Now, turning to gross international reserves, we show that the reserves rose to $5.2 billion at end September, which is equivalent to 5.2 months of import cover. These are imports which are prospective imports, that is looking ahead. This compares favorably to end June, when reserves were at $4.7 billion, which represented 4.7 months of import cover. The build-up in reserves was mainly due to the disbursement of $191.1 million from the IMF under the ECF arrangement. This is following successful completion of the fifth review. There are also project receipts that the country receives from the World Bank, AFDB, and other cooperating partners. Then we do have banks also here hold foreign currency deposits where we do apply the statutory reserve ratio. So those also add to this figure of 5.2 billion that we're talking about. We also made some purchases, and the interest earnings on reserves combined give us that $5.2 billion that I referred to. During the third quarter, turning to gold now, we made a purchase of 186.62 kilograms of bullion, monetary gold, with a purchase value of US dollars 21.5 million. This brings the total holdings of gold to 3,051.3 kilograms. That means 3 tons of gold with market value of $396.3 million since we started this program in December 2020. The current price of gold, you can see, has gone up. It's 4,115.68. This is per gram. So that's why people are fighting to get into gold production. You can see that's what is driving that. So the chart is just putting these numbers in terms of the gross reserves, chart 9. The current account, the external account, we say preliminary data because this tends to change from quarter to quarter because that's when we do the survey. So what we see at the moment is that the current account recorded a surplus of $0.03 billion or 0.4% of GDP compared to a deficit of 0.5 billion or 7.8% of GDP in the second quarter. So this is positive news in terms of the external sector. This combined with the fact that you have reserve builders is what also works as an attraction to those who want to invest in our economy. This was due to a stronger growth in exports than imports and reduction in reinvested earnings. Exports grew by 22.1% to 3.7 billion on account of higher copper export earnings and non-traditional exports, that is maize, barley, tobacco, electrical cables, cement, and lime, as well as gemstones. So all these are areas where there's a scope to actually increase. It would be actually much better having this grow quite significantly as we raise copper earnings, because then that means we have a diversified base for export earnings. So on the right-hand side, we are showing you the same information, but in graphical terms. Further, on the current account, imports increased by 11.8% to $3.1 billion. This chart on the right shows this. I think what is important also here to point out is that if you look the gray shade on that, that represents intermediate goods. So yes, you have imports going up, but if they are of intermediate good nature, then it means that they are going into productive areas. So the consumption, which is the blue, the green there, is what we want to control. Because when you are consuming so much, this is why people say we are import dependent, but we want more of this to go into productive areas so that, one, we can cut down on imports. Two, we can generate, because when you export raw materials as we do, we are actually exporting jobs. Because those who produce the goods that we import, that means they employ more people. So that's the balance that we need to strike. So the demand, as I indicated, was sustained by these very variables I referred to on the right, in the right hand chart. Now, again, looking at the current account in deeper into detail, we tried to look at what is the situation in terms of imports of diesel, especially when you look at that from the time the open access was done. So you see there's a line there which is with an arrow. You can see that import of diesel has reduced since that open access has done. Now, here there are two things. It's not so much the volume, but the pricing of this is what is contributing to this. That's what we are looking at, because that's what the open access is supposed to deliver lower prices for the commodity. Turning to credit developments, we note that overall domestic credit growth rose to 17.4% year-on-year in September from 12.7% year-on-year in June. This is what is shown in the chart on the right-hand side. So the blue shading there, that represents private sector, which grew by 21.4% from 19.8%. This was largely on account of lending to electricity, transport, agriculture, and manufacturing sectors. Lending to government did also increase due to heightened demand for government securities. Here, you may recall, many of you may now perhaps be also participating in the auctions that go or purchase of government securities through the portal that the bank developed. So this is producing some of those results. So that in government borrowing increased through government securities. We see that outstanding government securities stood at $242 billion at end September. Out of this amount, non-resident investors were accounting for 61 billion kwacha, or 25.4%. So this is a segment we always keep an eye on. You remember earlier we thought that then the coupons are not converted, they do this. But at the same time, when they come to participate in this market, they bring along dollars, which augments our supply of foreign exchange. There are two things that happen when we experience that. One is that addition to the holdings of dollars, but also they contribute to the movement in the interest rate on government securities. So it moderates that because there's more demand, which means that the government then can get at a reduced cost to the treasury. Economic activity. Here we see that there were further improvements in the third quarter with favorable business conditions for the private sector, as reflected in Stanbic Bank Zambia Purchasing Managers Index. This is the one we show on the right-hand side. You can see that when there's that line there, the 50, line. If it's below, it shows that there is activities constrained. But if it's above, it shows that it is quite positive. And the bigger that movement, the better. So what you see here is that there was a slight reduction, the last bar there, but it's still quite noticeably sizable. Then the other thing that we do is we do undertake a quarterly survey of business opinions and expectations, which also shows that there were improvements in economic activity. So the way to look at this is that you look at the color coding. The red is what was in the Q2, and then the greenish color there, that is the third quarter information. So you can see that the third quarter shading is in enveloping the whole of second quarter. The red is entirely inside in all the variables that we are measuring. So that is indicating that the businesses are saying there is improved activity. So the average, when now we took them together, obviously, the average is affected by the extremes. So you see that it comes a nice figure, but really what is of significance here is that in the third quarter, economic activity was much, much better. Further, in terms of the growth prospects over the medium term, we show that these remain bright, and all these different ways of looking at growth, each one of these use different ways of estimating or projecting what growth. They all come out showing that growth is on the upward direction trajectory. And there has been quite heightened talk on this because it's extremely important. The government mantra is growth, more growth, and more growth, which means that we have to grow. Why do we have to do that? It's because even the debt restructuring that we have, the debt overhang, part of it, a large part of it, is because we have not been growing. So if the economy was growing, we would not face that constraint that we are facing. Also, with the more growth, we should be able to absorb some of the unemployed youth and the others in the market. So growth is very important, more so if that is in sectors such as agriculture, tourism, which require a lot of hands to do. Because mining, as you know, is much, much more capital intensive, so they don't employ as much. But the existence of the mining sector has got a lot of linkages to other sectors. You can very well imagine where they are doing their work. Those of you who have had the opportunity to go to the mining companies, you see a number of satellite activities in the vicinity. So we urge that this continues to be the case, but we are talking of inclusive and sustainable growth. Oops, what did I do? Okay. Now, come to the conclusion. All this, what I was talking to, was to explain why we came to this decision. You can see that there are these positive developments going on. The economy is growing, inflation is coming down, the exchange rate has appreciated, but we are also mindful that although inflation is coming down, it is still outside the target band. We also see that the expectations of players out there, though they are coming down, they are still elevated. Geopolitical tensions are easing, but they haven't quite gone away. Therefore, as a committee, we felt that it was important to move cautiously, and hence our reducing the monetary policy rate by 25 basis points. This notwithstanding, okay, I've already mentioned that, so maybe I shouldn't say that again. So in short, we have reduced the policy rate because of those developments that I have referred to. So this would end the presentation in terms of explaining the decision of reducing the policy rate by 250 basis points, or 0.25 percentage points. Now, let me move to something which has been making rounds in the media and the economy generally. I think the debate on FDI is quite rife. So we thought that it would be helpful during this presentation to also say something about how this is faring. So what you see on the right-hand side is FDI is growing. Now, it's only in 2022 where there was this dip, but otherwise we have had positive flows. Now, what sometimes gives rise to the misreading of the information is that when people are investing here, it is recorded as a liability because it's accounted by those who invested in their home country. So when we invest outside, those are our assets outside. So sometimes it's possible that people misread this and they say, it's a minus. That means there are outflows to the FDI when you are saying that they are inflows. It works the other way around in recording. When someone invests here, it is a liability. It means it's like you depositing money in a bank. The bank is happy to receive those deposits, but at the same time, it recognizes that that's a liability because at some point they have to be paid back. So, but when they have that money, obviously they have the opportunity to invest it. So similarly here, when someone brings in money, it's a liability to us because at some point they will want, and that's what happened in 2022, that there were net payments of dividends to the investments people had made earlier. So the idea is that when it comes, obviously it generates the employment that we are looking for, technology transfer, and all those other things. So this is what this is really showing here. So it's part of the presentation, so you will see the details later. The other thing that we thought we share information on was remittances. We do have positive remittances from the diaspora. So in terms, this works both ways. There are also people who are non-Zambians who are working here. They also remit to their respective countries. But on the balance of things, there are more inflows than there have been outflows. So here too, we give you more detailed information, which you may find useful when you look at the presentation that we have today.